Step-up basis. Let's say you bought Amazon stock for $10,000 in the early days, and now it's worth $10 million. If you sell it, you'd pay taxes on that $9,990,000 gain. But what if you just hold on to it until you die? Well, when you die, your heirs get that stock with what's called a stepped-up basis. This means the IRS pretends the stock was always worth $10 million. Your heirs can sell it immediately and pay zero taxes on those millions in gains. The wealthy call this the die and win strategy. Buy assets, watch them grow, never sell them, then die. Billions in profits escape taxation completely. The Tax Policy Center estimates this costs America about $40 billion yearly in lost tax revenue. This single loophole is why many wealthy families pay almost no taxes across generations. Borrowing against assets. Why would a billionaire with $50 billion in stock take out a loan to buy a yacht? Because it's their secret tax strategy. Here's how it works. Instead of selling stock, which would trigger taxes, the ultra-wealthy borrow money using their stocks as collateral. These loans often have super low interest rates like 1 to 2%. Banks love making these loans because they're extremely safe. The wealthy person gets millions in spending money without selling a single share or paying a cent in income tax. They can use the borrowed cash for anything: mansions, private jets, or even more investments. Later, they either pay back the loans with new loans, keeping the cycle going, or the loans get paid off when they die, and their assets get that magical step up in basis. This strategy has a name in wealth management circles: buy, borrow, die. It's how billionaires can live lavishly while reporting little or no income to the IRS. Carried interest. If you manage other people's money on Wall Street, you get a magical tax gift. Your income gets transformed from regular income, taxed at up to 37%, into capital gains, taxed at just 20%. Hedge fund and private equity managers typically get paid 2 and 20, a 2% management fee, plus 20% of any profits they generate. That 20% profit share is called carried interest. Even though this is basically their salary for doing their job, the tax code treats it as if the manager invested their own money and made a profit. The difference? If a manager makes $10 million from carried interest, they save about $1.7 million in taxes compared to if it were taxed as normal income. Politicians from both parties have called this unfair for decades. President Obama said it was the single most egregious loophole in the tax code, but intense lobbying from the financial industry has kept it alive. When lawmakers try to close it, Wall Street opens its checkbook. The loophole continues, saving fund managers billions in taxes every year. Real estate depreciation. Imagine owning a building that's actually going up in value, but on your tax return, it shows a huge loss. Welcome to the real estate investor's favorite trick. The tax code lets real estate investors claim something called depreciation, a deduction based on the idea that buildings wear out over time. A commercial building's cost can be deducted over 39 years, while residential rental properties depreciate over 27.5 years. Here's the magic part. Even if the property is actually increasing in value, as real estate often does, investors still get to claim this depreciation deduction. This creates paper losses that can wipe out all the rental income and sometimes even offset other income. Donald Trump's tax returns showed this in action. In many years, he reported massive losses despite owning valuable properties, allowing him to pay little or no federal income tax. When a New York Times investigation revealed he paid just $750 in federal income taxes in 2016 and 2017, depreciation deductions were a big reason why. Even better for real estate investors. When they sell one property, they can use a 1031 exchange to buy another property and defer all capital gains taxes indefinitely. Offshore taxes. Imagine a tiny office building in the Cayman Islands that's the official headquarters for thousands of companies worth trillions of dollars. This is the world of offshore tax havens. Wealthy individuals and corporations shift profits to countries with low or zero tax rates. Apple famously created a subsidiary in Ireland that collected massive profits from intellectual property, profits that weren't taxed in America or even in Ireland due to clever legal structuring. The Paradise Papers and Panama Papers leaks revealed how widespread these practices are. Even though some of these strategies cross from legal avoidance into illegal evasion, enforcement is difficult because these transactions are incredibly complex and hidden behind layers of shell companies. The most shocking part? The Tax Justice Network estimates that around $36 trillion in wealth is held offshore, costing governments worldwide about $600 billion in lost tax revenue each year. That's money that could build schools, hospitals, and infrastructure. Charitable foundations. When Mark Zuckerberg announced he'd give away 99% of his Facebook shares to charity, it sounded incredibly generous. But there's more to the story. By putting billions into his own charitable foundation, Zuckerberg gets massive tax deductions now while maintaining control of the money. Private foundations are only required to spend about 5% of their assets yearly, meaning 95% can remain invested and growing tax-free. The wealthy often donate appreciated stock to their foundations, getting a tax deduction for the full market value while never paying capital gains tax on the appreciation. If someone donates $10 million in stock that they bought for $1 million, they get a $10 million tax deduction and never pay taxes on that $9 million gain. Even more creative, some billionaires use foundations to employ family members, fund pet projects, or enhance their public image. The foundation can pay for lavish events, travel, and office space that benefit the founder while technically serving charitable purposes. This doesn't mean charitable giving is bad, but it's worth understanding that when billionaires make giant charitable pledges, they're often also getting enormous tax benefits. Trusts. The ultra-wealthy don't just plan for their taxes this year. They plan for generations. Their secret weapon? Trusts. A trust is basically a legal entity that can own assets. The wealthy use complex trusts to transfer massive wealth to their heirs while minimizing or eliminating gift and estate taxes. The Grantor Retained Annuity Trust, GRAT, is a favorite. Here's how it works. A wealthy person puts assets into a trust for a short period, like 2 years. During those 2 years, they receive payments from the trust. When the term ends, any appreciation above a very low government-set interest rate goes to their heirs tax-free. This might not sound impressive until you see it in action. Facebook's Mark Zuckerberg reportedly put pre-IPO Facebook shares in GRATs. When Facebook's value exploded after going public, billions transferred to his heirs without any gift tax. The Walton family, of Walmart fame, reportedly used GRATs to transfer about $7.5 billion without paying estate or gift taxes. Other trust varieties, like dynasty trusts, can preserve wealth across many generations while avoiding estate taxes at each death. Some trusts can even be used to get tax deductions now while providing benefits to heirs later. Capital gains. Why does a hedge fund manager earning $100 million pay a lower tax rate than a doctor earning $300,000? Because of how different types of income get taxed. Income from work, like salaries, gets taxed at rates up to 37%. But income from investments, capital gains, and dividends maxes out at just 20%, or 23.8%, including a Medicare surtax. The ultra-wealthy structure their finances to receive almost all their income as capital gains rather than ordinary income. Warren Buffett famously noted he pays a lower tax rate than his secretary because most of his income comes from investments. This difference is the foundation of tax inequality in America. In 2021, the 25 richest Americans had a true tax rate of just 3.4%, according to a ProPublica investigation. How? They hold appreciating assets, rarely sell them, and use other strategies on this list to minimize their taxable income. Private placement. Imagine an investment account where you pay zero taxes on your gains, ever. That's private placement life insurance, PPLI, a strategy used by the ultra-wealthy that most Americans have never heard of. Here's how it works. A wealthy person buys a specialized life insurance policy but funds it with way more money than needed for the death benefit. This extra money, often millions or tens of millions, gets invested in almost anything they want. Stocks, hedge funds, private equity. The magic part? All investment growth inside the policy is completely tax-free. No capital gains tax, no income tax, nothing. When the person dies, heirs receive the investments free of income tax and potentially estate tax as well. The minimum investment is typically $2 to $5 million, putting it out of reach for ordinary Americans. But for the ultra-wealthy, it's a private tax shelter that's perfectly legal. This is one reason why effective tax rates fall dramatically at the very top of the wealth spectrum. Opportunity zones. In 2017, a new tax break called Opportunity Zones was created, supposedly to help poor communities. In reality, it became another way for the wealthy to slash their tax bills. Here's how it works. Investors who sell assets and have capital gains can defer and reduce those taxes by investing in opportunity zones, areas designated as economically distressed. If they hold these investments for 10 years, any new gains are completely tax-free. Sounds good in theory, but in practice, many opportunity zones include luxury developments in already gentrifying areas. Jared Kushner and his family reportedly used opportunity zone investments to build a luxury apartment complex in New Jersey. Former NFL player Marshawn Lynch used an opportunity zone to build a real estate project in Portland, Oregon. A study by the Urban Institute found little evidence that the program actually helps poor communities as intended. Instead, it provides massive tax benefits to wealthy investors while often accelerating gentrification that displaces existing residents. Deduction limitations. Tax deductions get phased out or limited for upper-middle-class Americans, but the ultra-wealthy often avoid these limitations entirely. For example, state and local tax, SALT deductions are capped at $10,000 for most taxpayers. If you live in a high-tax state like California or New York, this cap significantly increases your federal taxes. But billionaires can avoid this cap by structuring their businesses as pass-through entities that pay state taxes at the business level, not subject to the SALT cap. Another strategy, donate to state-run charitable funds that provide tax credits, effectively converting non-deductible state taxes into deductible charitable contributions. Similar workarounds exist for almost every deduction limitation in the tax code. The wealthier you are, the more resources you can devote to finding and exploiting these loopholes. These tax avoidance strategies aren't usually illegal. They're built into our tax system. The ultra-wealthy hire teams of accountants, lawyers, and financial advisors to minimize their taxes using these perfectly legal methods. The result? While the average American pays about 13% of their income in federal taxes, the very wealthiest often pay a tiny fraction of that percentage on their true economic income. Did you enjoy this breakdown? Then please subscribe and hit the notification bell.